Welcome back to the very first training session of AML Center in 2026. We are really happy to have such a wide audience here dedicating their time to know more about cybercrime. So, this is the second part of our training session after the short break. I hope that you had a nice walk or grabbed a cup of coffee or water. And now we are joined by our second excellent expert, and we are switching to presentation in English. And we have Pamela Clark here today, head of growth strategy of Inca Digital. She is an expert in the field, and she will be delivering presentation of practical understanding how actually cybercrime is generating these funds. And Pamela, without further ado, the floor is yours. We are awaiting your presentation.
Great, thank you. Hello, good afternoon, everyone. It's a pleasure to be here with you guys. So today we're going to talk a little bit about a couple different aspects that we see happening with cybercrime and the utilization of crypto. The first one we're going to talk about is a fairly well-known case. We'll just walk through how it happened and what the cyber aspects of that look like. But then we're also going to talk about the use of stablecoins by cybercriminals. It is, stablecoins have become by and far the most used digital asset for illicit activity. And of course, while most cybercrime does not exclusively use crypto is widely used in certain types, which of course involves ransomware, online scams, dark markets, cyber-enabled extortion, money laundering of hacked funds. So we'll talk a little bit about this and what the stablecoin transaction lifecycle looks like, and where, as AML professionals, we would generally see controls put in place or not put in place in the use of stablecoins. So let's get started first here with the Bybit hack. This, of course, was all over the news. You guys most likely saw this because it was perpetrated by the Lazarus Group. And we all follow that group because they are a North Korean hacking group. As we know, they're all state actors. So this one in particular was done by Trader. It's a play on words. But you can see there the trader, so someone who betrays and someone who's trading. So this was specifically executed by that particular hacker, and it targeted Bybit's ETH cold wallet. So this was a very large hack. You guys saw on the other side there, $1.4 billion. And I think it's really important here, what we're going to walk through and look at how this hack or attack happened is that, again, as in all the other cases in crypto and crypto hacks and exploits, Lazarus did not break cryptography or steal the keys. They poisoned the signing interface, which we'll walk through there, which basically tricked the multi-sig operators into authorizing a malicious contract upgrade during the case. So we'll start very simple and kind of walk through some of the more technical aspects of this. But essentially what Lazarus did was they targeted Bybit's cold wallet, right, which was using safe multi-sig. So Bybit stored their ETH in a multi-signature cold wallet that was managed through Safe Wallet. The design of this is that funds are stored in a multi-sig smart contract, which multi-sig, if you're not familiar, guys, just means that you have to have more than one person sign, right? More than one signing to be able to execute transactions. So that means that multiple authorized signers, hardware wallets, are required for that. It uses Safe's web interface and SDK to prepare transactions. So even though it's a hardware wallet, right, so it's a separate device, you still have to use the web interface when it comes time to actually execute the transaction. And so this setup should prevent a single compromised key from draining funds, okay? However, the attack here by Lazarus actually exploited off-chain infrastructure and not the blockchain contracts, okay? So This happened back in, you can see there the timing of it all. The initial compromise, right, was that the attack started with a compromised safe developer environment. Okay, so the actual safe wallet developer environment, they compromised the attackers. The Lazarus group were able to compromise a developer machine, gain access to Safe Wallet's web client infrastructure, and they injected malicious code into the web interface. Okay, so this really, if we look at it on just typical cybercrime activity, this would be classic supply chain compromise, right? If we really just break it down into kind of traditional cybercrime. Okay. Okay. Then let me go back one more because I haven't talked about the JavaScript. They were able to inject malicious JavaScript into the Safe UI, right? So the attackers injected the JavaScript into the Safe web client, okay, that's hosted in the cloud. And then when the signers opened that interface, the malicious code ran in their browser. It intercepted transaction data, and it replaced the legitimate transaction with the malicious one before signing. Okay, so this attack actually modified the transaction parameters only during signing process. Okay, so the key vulnerability here was transaction substitution before signature. Okay, so they were able to detect if the user was a Bybit user. They cloned the legitimate transaction. They replaced the transaction payload with malicious instructions. Then they sent the modified transaction to be signed. And then they restored the original transaction data in the UI. Okay, so the signers, the Bybit signers, saw a normal transaction, but they signed the malicious one. Okay, so I think that's really important when we look at this. So what happened was, right, the safe contract was effectively upgraded and redirected. Attackers obtained operational control, and then those funds, so we see here the funds were transferred to attacker-controlled wallets. We're talking about approximately 400,000 ETH, which is $1.4 billion. Okay, and this thus became the largest crypto theft in history. So we can see here the exchanges, right, that were receiving the funds. Once the attackers receive the funds, they still need to be laundered. They still need to go through an off-ramping process. Okay, so we see here that the funds were sent to 13,000 different addresses, right? And this makes it difficult for exchanges to monitor and freeze when it's 13,000 addresses. So while everyone was tracking this and everyone was fairly up to date on the event as everything progressed, it's difficult for exchanges to upload quickly 13,000 addresses to their transaction monitoring system or to their, a blacklist or, whatever system that they're using for KYT, okay, for Know Your Transaction. The exchanges included Mantle and BitGet, right? That were actually able to freeze some of this money. So you can see there 42 million were frozen by those two exchanges alone, but that only represents 3% of the total hack. Okay. They were also able to recover 15,000 ETH from after the hack. And so there was a lot of community cooperation involved immediately after the hack. Again, just because of the sheer size of the hack, this was well known from nearly the beginning, and a lot of the community members were tracking the funds and taking action to freeze the funds as much as possible. I do want to point out here, and I think this is really important for us, given the topic today, which, in the center, the Anti-Money Laundering Center, there are still many exchanges around the world that do not cooperate either with certain law enforcement or just do not cooperate with the community. So for even those exchanges that may not cooperate with European or US law enforcement because of their jurisdiction, in many cases, when there is such a large hack or vulnerability or an exploit that takes place, those exchanges will still cooperate with the crypto community, right, to freeze funds or to take action. You could look at Tether, for example. Tether isn't necessarily a US entity, and they are not technically beholden to US law enforcement. Of course, Tether has a new US entity that they have opened and established, but yet they will take action when it is essentially something that is for the greater good of the crypto community, right? So I want to highlight here this exchange, EXCH, they received $94 million worth of the funds, but they refused to respond to Bybit's request. So again, you'll notice this is a request from Bybit, not law enforcement, to freeze the funds. So this would be something that I referenced here where it's more of a community working for the greater good of the crypto community. Exchange is centralized. They are not KYC exchange, so they do not perform KYC on their customers, and they're registered in Belize. So they also use Thorchain when they lack liquidity. Thorchain primarily uses this to bridge ETH into BTC, right? So what happened here was 3 of the validators for Thorchain actually voted to halt ETH trading on Thorchain because of this. And it led to one of the lead devs actually stepping down. So, like I said, when an attack or an exploit that is this large, because it moves the crypto markets, right? And it really causes a lot of panic within the space as to the security of the entire crypto industry. So we actually will see a lot of actions that are taken within the community wherever it is that they can kind of make an impact. So, validators, we saw here, validators can vote, devs can vote. So, when we talk about, it is very kind of democratic in the way that it works, but once you start getting groups of validators that decide that they're not going to execute, or they're not going to allow for trading to happen on a certain platform, then those are actual options that can be kind of leveraged to stop the flow of funds in cases like this. So here we see that this in January 2025, Femex, which is a Singapore-based centralized exchange, was hacked for more than 85 million by Lazarus Group. Okay. The hackers behind Femex sent approximately $96,000 to this particular address. Okay. The Bybit hackers also sent 1.3 million into this same address. So we saw an address overlap here between a previous hack and the Bybit hack, right? They actually sent funds into the same address. Okay. We saw also similarities to previous Lazarus hacks at Wazirex and Radiate Capital as well. So you can see there on the right side of the screen, those flow of funds where we see actual overlap from other Lazarus attacks to the Bybit attack as well. Okay, this attack was also significant for Bybit because it put them at a risk of insolvency, right? So the majority of Bybit's ETH holdings were stolen. I mean, just look at those numbers. That's quite, those are quite large numbers there, right? When we think about how much ETH that is, and for an exchange, that could be all of their ETH holdings. In this case, it was the majority of their ETH holdings. So then what happens at the exchange is it creates panic, just like a bank run, as we would see in the traditional space. And someone would make a run on the bank and want to withdraw their funds from an institution if they are worried about that institution collapsing, or they're worried about the security posture of that institution. Because naturally, when the hack happened, nobody knew at that time, right? It took a while to investigate and figure out that it was a safe wallet, that it was actually an exploit, that they had actually injected malicious code into the web interface. And so at the beginning, everyone is looking at Bybit and assuming that it's Bybit's fault, or that Bybit had some type of an insider breach. So naturally, a lot of the Bybit customers were wanting to withdraw their funds. Okay. So, Bybit was able to process those withdrawals, but it did put them at a significant risk of insolvency, which we saw previously with FTX, right? When an exchange collapses like that, when a large exchange collapses, it does create an unfortunate ripple effect throughout the industry. And it does lead to other incidents of usual fraud and scam and other, general money laundering cases, because you're going to see users trying to recoup their losses. You're going to see insiders at the exchange who may be holding funds at the exchange or may have been getting paid at the exchange. They're also going to try to protect themselves. So it does create quite a problem for not just the users of the exchange, but the entire industry as a whole. So Bybit was able to secure the total amount of ETH hacked through bridge loans and OTC purchases and other purchases. And so they were able to update their proof of reserves report on February 23rd, which showed that they returned to a full one-to-one backing on their client assets, right? So they were able to basically find the capital to continue the exchange and prop up the exchange. That said, there's always questions. What incidents like this do in the space, I think it's really important. It's almost important that these incidents happen, because when they happen, they highlight vulnerabilities, or they highlight bad security practices across the board. So, back to the FTX situation, obviously FTX was rather unfortunate. There was a lot of fraud and theft happening, and Sam Bankman-Fried is in jail now. But what it does is it highlights those issues. It highlights those vulnerabilities. It highlights those bad practices that are happening in the industry. And it forces the other exchanges that remain in the space to improve their security posture, or to improve their AML program, right? So when we look at Binance, when Binance got in trouble and CZ got in trouble, and we saw that entire process play out, that really forced other exchanges to improve their AML programs. So regulation, of course, goes a long way, naturally. Of course, everyone wants to, or has to, follow the regulatory regime within their jurisdiction. But also these incidents within the industry really force others to improve their own posture, or they may be vulnerable to the exact same issues here. So Bybit uses a Merkle tree implementation that might enable them to underreport liabilities. So this is something that's really important as we're looking at, issues, especially as we start talking more and more about stablecoins and looking at how we look at proof of reserves. So it can be this path instance here essentially can be constructed to only reflect the highest balance while the remaining balances are omitted. So the total liability displayed would actually be lower than the actual liability sum. And so a sudden mass of withdrawals could lead to Bybit not being able to meet their customer liabilities, right? So it just goes back to an insolvency question. So, we looking at this, right? This was, of course, the largest crypto theft to date, nearly 800 million more than the Ronin network's 624 million hack in 2022. Ronin was the largest at its time. Obviously, I think one of the key takeaways here for us, especially as we talk about cybercrime today and criminal activity, is, the Lazarus group continuously evolves and they're continuing to update and they're continuing to improve their abilities and their tactics. The laundering here outpaced tracing, right? I think this is one of the key takeaways is, as I mentioned, the speed at which they were able to launder these funds was faster than what anyone in the industry could do to trace or track or identify those addresses. And so that's with, there's obviously multiple blockchain analytics firms out there, right? Whether it's TRM or Elliptic or Chainalysis or Merkle or Crystal, right? So all of those kind of working at full speed and trying to identify the addresses as these funds moved throughout the infrastructure, throughout the blockchain, they still weren't able to keep up with the funds and identify those addresses for the exchanges in a timely fashion for those exchanges to actually freeze the funds. So this just shows you how well organized. Most of this, of course, is computer programmed, but when those funds hit the exchange and Lazarus is able to receive those funds and then immediately execute another transaction and move those funds off the exchange or execute a withdrawal from that exchange, that just shows how well organized this group really is, okay? Of course, they're always searching for new attack vectors, right? And so, really looking at traditional intelligence techniques are key here, right? So we need risk intelligence, okay, to be able to prevent future attacks like this. The exchanges have to continue to coordinate between each other. We see that some, right? I think it really depends on the incident. I think it depends on the situation. In a case like terrorism financing, we see exchanges coordinate, right? That's pretty straightforward. But we don't always see exchanges coordinate on other criminal activities. And some of that is because of their jurisdictional restrictions. Some of that is because of the varying compliance programs, right, between each exchange. And so it just, that cooperation between exchanges is imperative here. Also too, for custody of funds at exchanges, obviously there's a lot of mitigating controls that can be put in place, right? The separation of cold wallets. You can also, exchanges should, whether centralized or decentralized, what have you, but crypto entities should actually have bug bounty programs, which, encourages white hats to monitor for vulnerabilities, right? And so if they find one, then they are paid for finding a vulnerability, because if we can find the vulnerability and fix it before the bad guys find it, then that's one of the ways that we can protect and have better security practices. So, if we think about like a bug bounty program here, right? A 10% bounty instituted by Bybit, right, would have been a small price to pay here, as compared to $1.4 billion hack. And then also two verification tools to ensure the transaction shown is what is actually being signed. So I think that's important. So here's the bug bounty program. You can see an example of it over here. But they really need higher bounties is what we're arguing here. It needs to be worth the time of the white hat to go out and find those vulnerabilities. Okay, so that's kind of the review of Bybit, walking through the issue there and looking at how Lazarus was able to exploit the structure, the web interface of Safe Wallet and pull that out. What I also wanted to touch on today is the use of stablecoins, because stablecoins have become, I think at every single conference I go to, I hear the word stablecoin at least 25 times. And it's not always being discussed by entities that A, understand crypto, or B, have the knowledge to safely implement the use of stablecoins. And so I want to touch on stablecoins and how they're being used. Greta, do we have questions on the Bybit? Do you want me to answer Bybit questions first? Sorry.
We have some questions. If you want to answer questions on Bybit first, we can do that, obviously. Which one do you prefer, Pamela?
Yeah, let's answer some Bybit questions before I move on. Sorry, I was going to stop and make sure that there were no questions before I moved on. Go ahead.
Yeah, so we can jump into the questions, though after your session, we're going to have the general, more broader session. But just a few before we jump to another subtopic. So some people would like to know, is it safe to say that the Lazarus Group was specifically targeting Bybit? Was there anything specific about them that made them attractive to the criminals to attack them?
Yeah, it does appear that the code was written specifically to identify a Bybit signer. And so the code that was put into for this logic did have a part of it to detect if the user is a Bybit signer in there. So yes, it does appear that they were specifically targeted. That part we don't know why Bybit. They're obviously their reserves were very transparent. There could have been insider, knowing that they were a Safe Wallet user, right? There are a lot of different pieces there. So they obviously had some knowledge, and that could have been other cyber activity that gave them that knowledge, whether they were able to, look at, read chats, get into DMs, whatever, to be able to understand that they were using Safe Wallet. But yes, they particularly targeted them.
Yeah, and they are one of the major exchanges, obviously, worth the time,
yeah,
right?
Yeah, you go for the big one. Yeah, you want to go for the large payout. Yes.
Obviously, right. Another thing that was quite interesting, and to me as well, by the way, when we were discussing the volumes, the huge volumes that went to EXCH exchange, and they refused to help. Usually, that's uncommon in the crypto community. Why do you think they refused to help?
It's unclear. I think one thing that's important here is, they don't do KYC. So I don't, maybe they tried to be agnostic, or maybe they tried to just be as hands off as possible. I would say also too, based on just what I know about the exchange, I don't know that they have a lot of kind of backend or admin on that side. So maybe they couldn't help. or, it may be one of the cases where, they had devs build the infrastructure, build the exchange, and then really they're just kind of like in maintenance mode. So it's unclear. I don't know the answer to that, but that based on what I know about them, those would be my assumptions.
Mhm. I see. One last question, and I will allow you to return to the rest of your presentation. It is fantastic. I'm having the blast here today. I hope that everyone else in the audience as well. So while Bybit had to reestablish the reserves, right? They had to go and look out everywhere for the assets. And then the question is, did they look enough into the origin of these assets, or they were more concerned about restoring the liquidity and just being fully operational again? Your
Oh,
opinion, obviously, don't
yeah.
have the answer, right?
No, that's such a good question. That's really another area that puts them vulnerable, right? Is that they're just going out for an asset grab and they're trying to obtain they're trying to cover those assets as quickly as possible. And so, yeah, you could definitely see how there could be questionable funding for that. That would be a really great way to potentially get a quick transaction for a sanctions evasion or something if they had actually gone to some of the more questionable sources of funds for that. You did see on there that they went to OTCs, so over the counter traders. As usual, the typical AML risk exists with OTCs in that you do not know where those funds originated on the other side of that trader. And unlike an exchange where funds are a little bit more cleaned in the sense that they're generally moved through some type of an omnibus or a hot wallet, that risk carries over, right? And we've seen that time and time again where somebody obtains funds from an OTC. Those funds were coming into the OTC high risk, and that risk, because because it's not those aren't commingled enough, that risk continues over to the buyer of those crypto funds. So that's a really good point. I haven't thought about that. That might be another case that we could go and look at where they obtained all of the funds to cover their losses, and if any of those were in particular high risk. Yeah, that's a great question.
Very interesting area to look into. Yeah, we are good for now, and I welcome you to return to the rest of your slides. Thanks.
Great, thank you. Those are great questions. Thanks, guys. So yeah, so let's just talk a little bit about stablecoins with the last. I think I have 8 minutes left, Greta. Maybe yes.
Yeah, you
Okay,
do. You
perfect.
have 18 minutes. Yeah, 8 minutes.
Okay. So we're just going to go through stablecoins quickly and just look at, a couple different aspects of stablecoins here. The reason why I wanted to really kind of wrap up with stablecoins, and we're talking about cybersecurity today, is just because stablecoins have increasingly become the preferred tool for illicit activity in the crypto ecosystem. So, unlike more volatile assets like, obviously Bitcoin or ETH, stablecoins, as you guys know, are pegged to fiat currencies, whether that's dollar or euro. Of course, the most widely used stablecoin, Tether, is pegged to the dollar, and then USDC is the second most used, but also pegged to the dollar. And so it makes them attractive for criminals because they maintain stable value, and they're easy to transfer across border. So that I think that's really important. The other aspect about stablecoins, as the stablecoin market evolves, and as we see, even in the US now, we have regulation for stablecoins, is that another key aspect here is that they are becoming easier and easier and quicker to convert into fiat, right? Everyone is creating an on and off ramp. Everyone is building out a fintech that allows for that quick transition. And so that's also really attractive to criminals. So, even though we've seen lots of financial action task force has warned about stablecoins increasingly, we in peer-to-peer transfers that bypass intermediaries, which of course complicates AML oversight on those. Stablecoins now account for the largest share of illicit crypto transaction volume. And that's from various different assessments. Some of the most recent estimates by regulators actually suggest that stablecoins could account for an even larger portion of illicit activity in some categories, particularly in sanctions evasion and large-scale fraud networks, right? So I think the sanctions evasion one becomes ever more complicated. This is an important piece. I just want to walk through the kind of the ecosystem of stablecoins so that you can really understand all of the players involved. And so we can think about, I think this is really important because as we think about where controls can be put in place, where AML can have an impact, it's really important to understand each player and how they actually, what their role is in the space, right? So you can see the stablecoin issuer. If there is stablecoin regulation in place, which in many places there is now, many countries, then the stablecoin issuer is a regulated entity. Those can be trust companies, banks, fintech payment firms. The issuers issue and redeem tokens. They manage the reserves. They can maintain compliance as well, and they do report to their regulators. Okay. Now, depending on the stablecoin issuer and the actual regulation in place, they may or may not have compliance at the level of like KYC. They most likely are not KYCing all of their customers, but they do in fact monitor the ecosystem and monitor their tokens and identify any high-risk addresses that are holding those tokens in most cases. So we'll walk through that. We'll look at that and walk through that here in a minute. Also reserve the reserve banks and custody, right? So any stablecoin issuer has to hold reserves for those stablecoins in circulation. So of course we have banks and custody providers for the safekeeping of the reserves and the settlement. Obviously, they're going to have traditional controls in place. Okay. Infrastructure providers. Now, obviously, we have stablecoin white labelers and tokenized platforms. So they will actually issue tokens and measure the treasury. The blockchain networks, right? As we see more and more compliance that can be built into smart contract enabled blockchains, I think we will see more compliance moving on chain. Of course, the exchanges and distribution, right? Those centralized exchanges, this is important. Not only do they provide the liquidity and the fiat on and off ramps, but this is also a know your customer control that should be put in place, right? This is where we can have KYC. Of course, your wallet and user access, right? Your mobile wallets and your web extensions. These guys have the ability to put some controls in place. We've seen it before. It's not common entirely with wallet providers, but there's possibilities there. Then, of course, we have compliance and monitoring, right? The blockchain analytics firms, your financial compliance specialists, kind of what Inca does on the back end. We don't just monitor transactions, we actually monitor the ecosystem for, like PayPal stablecoin and for some other governments that have issued that. And so it's really about like looking at the holders and how that token's being used in the space and putting in secondary and tertiary controls in place. So we'll just look real quick here at the life cycle of a stablecoin, just to understand again where those controls can be put in place. I think that's really important. If we miss controls, right? If we miss the KYC, if we miss the ability to whitelist an address or to have the blacklist addresses included, then there's other options that we can do in the ecosystem itself. But I think it's really important to understand when we talk about combating cybercrime, we talk about looking at the use of stablecoins. We can't just collect on chain. And this is something I talk about quite often, is we can't just collect on-chain data. We actually have to build in information from all sources so that we're able to, get overviews like this, right? So looking at the way a token is used after it's released into the ecosystem, after it's released into the market, right? And seeing how those users are behaving with that particular token and seeing what the users are saying about a particular token on social media or in Discord or on Telegram. Bringing all of that to the table, I think, is incredibly important. And that's one of the ways that we're able to preemptively identify criminal use of various different tokens. So if we can see those tokens, stable coins in this case, this is a sample, right? An anonymized dashboard. But if we can see those being prepared for criminal activity, we can see the holders either being concentrated, or we can see those holder addresses being dispersed amongst bots, or we can see those holders being concentrated in a particular geographic area or utilizing a particular exchange after holding that token, then that gives us the intelligence we need to be able to predict or preempt some of that illicit activity that we're going to see with a particular token. So here you can see also too, this is my last slide, but we can see also here, threat intel on a particular token. You can see the use of, how many scam contracts are out there, right? What those scam contracts, what are the scam contracts? What is the distribution of social media engagement look like? How are users engaging? How are users talking about this particular token? Where are these users based? Right? So you can see their geographic analysis when we talk about the use of social media, right? Where are these users based? What are they talking about? Are they suggesting that you could use this token for illicit activity? Are they encouraging others to, use this token for scam or fraud activity? This is all being discussed fairly openly within social media. So we want to bring that together with the blockchain data that we have, right? And so this is one of the ways that you can provide that additional layer, those additional controls to the ecosystem. If I do not get to answer a question, or if you guys have any questions or you just want to reach out, I put my email at the bottom here for you guys to contact me. Be happy to answer any questions or respond in any way that I can to anything I did not cover today in our session. Thank you, Greta. I look forward to some more questions from the group. Thanks.
Thank you so much, Pamela. It was so insightful and so packed with information. And I really loved your almost last slide where you actually show how we can layer that on-chain data with more information.
Yeah, that's a good one. Yeah.
And actually, I can see how we can move towards proactive action instead of being very reactive. But now is the time for Q&A session, and we'll try to do as much as possible. So Pamela, I'm getting back to you. I have a very interesting question about the PSD2 compliance through customer authentication. The dynamic linking, where the user explicitly sees and confirms the specific transaction details they are signing. Your opinion on this? Have this been proven to be effective in preventing Bybit fraud, or we are just misunderstanding different technologies and how actually advanced the Lazarus group was in this particular situation?
Yeah, so that's a really great question. So the answer is yes and no. So in principle, yes, it probably could have, but only if the transaction happened on a trusted independent signing device and the linked data covered the real security critical fields in the safe transaction. So the Bybit attack worked because the safe web interface was compromised and showed signers one thing while they actually authorized another, right? And so some analysis showed that the attackers altered what the signer saw. So they unknowingly approved a malicious transaction, right? So with the PSD2 style dynamic linking, it's designed to stop that type of a mismatch. The authentication code must be specific to the transaction details of the pairs. So if Bybit signers had been forced to confirm on a tamper-resistant device the actual destination and the effect of the transaction they were citing, then the attack likely would have been harder to pull off. However, I said no because I said it's also no because there's an important piece here, which is that plain PSD2 dynamic linking is written for like payment transactions would not have been enough by itself because these are complex smart contract wallet flows, right? So like, for example, the malicious Bybit, the Bybit transaction, it's not just send X ETH, send this much ETH to this payee, right? It involves, more kind of complicated, almost dangerous smart contract operations, which is using a delegate call style path that basically changed the control of safe rather than making it a normal transaction. So the crypto equivalent of SCA would need to bind and display more than the amount in the recipient, basically, in order to show that. So, yes, right? If properly implemented, SCA with dynamic linking model could have prevented it, but only if if we're able to adapt it for smart contract semantics, right? Which is not quite there yet, but I think the concept, right? The principle of it, yes. So that's a great question, Rima. Yeah, thanks.
Fantastic. So I would like to summarize the first training session and let you both go and continue with your really busy and packed schedules. I'm really grateful for all of the insights. What I am bringing with me today, if there's one thought, I clearly understand this is a business and criminals are profiting from that. And this is a very logical business. So we need to understand it, to better fight it and to better protect ourselves. So understand the criminal, understand how they operate, and take care of yourself. That's probably what I'm going to bring with me today. Thank you, ladies. You've been amazing. Thank you, everyone who joined us today in this sunny afternoon in Lithuania. Take care and see you in the next session. Bye-bye.